Hello everyone, very good evening to all. Welcome you all in the session of Oliveboard. I hope you all are fine and doing well. So please confirm my audibility and visibility. Yes, I hope everything is fine, everything is perfect. So yes, we have completed our module B yesterday. I hope you have watched all the sessions of module B. From today onwards, I'm starting module C and unit 13 is the very first unit of module C. So module C, it is very important module because in this the chapters which you will be finding, they will comprise of let's there is one chapter known as mergers, acquisition and restructuring. It is this particular chapter will give you approx 8 to 12 marks. This only single unit will give you 8 to 12 marks. So overall the weightage of this unit is 25 marks, and again it is what a theoretical plus numerical unit. You will be seeing some of the numerical parts as well as some of the theory parts. So let's start with the very first unit, that is corporate valuation. See, corporate valuation means what? If I want to purchase your company, let's take an example. Okay, this is me. If I want to purchase any company, let's take an example. The name of the company is ABC Limited. if I will if I want to purchase, so at least I should know what is the valuation of your company in the market, what is the actual value of your company, what is the actual worth of your company. So corporate valuation tells you, it helps in determining the actual worth of a company. What is its actual value? Right? So in this particular chapter, we will see that how a rational person will value his or her company for doing investments on you can say on different projects. So actually with the help of this particular unit we will be knowing how to value a company, how to find the actual worth of a company. Now let's go to the definition. So corporate valuation is what? It refers to the process of determining what? Economic value of a company of business entity. Again, it will involve various factors like financial factors, operational factors, all the internal factors which can be expressed in monetary terms, because ultimately we have to pay the cash, we have to pay the money. So, in order to find the value, in order to find the worth of the company, so everything is being estimated in terms of money. Corporate valuation is commonly used for purpose for the mergers, for acquisition, when two companies are merging together to making a new company, when one company acquires another company, when one company takeovers another company, for investment analysis, for reporting, for litigation, for any kind of purpose, we need to do a valuation of a company. What is the exact value? What is the exact worth of a company? Now, so corporate valuation is the process of determining the value of a company entity, and this can be done with two ways. One is the book value and another one is the market value. If you want to purchase any company, so you need to calculate the worth of that company. So if you will need to calculate the worth, so you can calculate the worth of that company with the help of two process. One is the book value. Book value means what? The value which is mentioned in your books of account. That is what? That is the book value. And market value means what? The value which is being in the market, like the value of your company. Similarly, if another company is there, so what is the value of that company in the market? So market value means the worth of your company in the market. What is the value of your company in the market? That is market value. Now, this particular statement is very important. The International Assets Valuation Standard Committee is responsible for developing the international valuation standard. So this particular committee that is located, it is located in the other country, not in India. International Assets Valuation Standards Committee. We have to follow the standards on the basis of this committee, and it is responsible for what? For developing all the internal valuation standards. That is IVS. So this particular statement is very, very important from the examination point of view. Yes. Now, so how to find a book value? Book value is what? A value which is mentioned in the book of accounts. Like if all of your assets, if you will deduct all the outsiders' liabilities. Suppose your assets are, let's take an example, the worth of the assets are 50 crore. Okay. Now, outsiders, all your debts, all your bills payable, all your liabilities, all are they approx how much value? 10 crore. Okay. Now, cash. So cash will also be deducted because if I want to purchase a company, so I will not going to purchase your cash. No, the cash is yours. So I will not going to purchase that to deduct cash. Cash, let's say 1 crore. Okay. So assets is 50 crore minus 10 crore minus 1 crore. So how much? 39 crore. So the book value is what? 39 crore. That is the book value of the company. Clear? Am I clear till over here? Any doubt? Now, what is market value? The market value. Market value means what? How many shares are traded in the market? The value of your shares, the value, the wealth of your shareholders. This is very important perspective for calculating what the market value of a firm. The value of each share and how many shares are sold in the market. That is the main important phenomena in market value. So how you will calculate? Like you have number of shares, and if you will multiply this number of shares into the price of market price of just a minute shares. Okay, so you will be getting the value of business as per market value. This is your value of business. Am I clear till over here? Okay. So how many shares are traded in the market, the value of each share, what is the value of how many shares are being sold in the market. So this will tell you the market value, the analysis of the corporate valuation with the help of market value. And how it is calculated, number of shares, how many shares you are holding in your company into what is prevailing, what are the market price of the shares. If you will multiply that, you will be getting the value of business. Then, like if I say like market price of the shares are let's take number of shares are how much, number of shares are 10,000 and market price of each share is, let's take an example, 50. So what is the value? That is 5 lakh rupees. So worth of the company is what? 5 lakh. That is the market value. Done. Now there are different approaches to corporate valuation. The first is income based approach. What is income based approach? It basically tells that how much revenue you are generating, how much there is cash inflow in your company. That is the CFAT, the cash flow after tax. That is the income approach. Your earnings, your EPS, earning per share. How much cash you are generating, what is the cash inflow, that is the CFAT, that is the income based approach. Okay, I'm purchasing your company. I know I have seen the balance sheet, I have seen the market value of your company, but please tell me what is the value, what is the cash you are generating in your company. how much you are making a profit, how much make you are making the revenue. You should tell me that. Then only I will make a decision to purchase your company or not. Clear? Income based approach focuses on the company's ability to generate future income or cash flows. What is your cash flows? How much more money you will going to earn in the future? In future, what are your CFAT? We should know that. Income approach, also known as capitalization approach, it helps in estimating a company's or the investment property. So we have for this discounted cash flow analysis. So discounted cash flow analysis, in the coming scenario, you will be seeing the DCF. We have one whole chapter, discounted cash flow and non-discounting methods. It basically calculates what the present value of a company's future cash flows. Means the money which you are getting now, that is more important the money which you will get in the future. It calculates what the present value of a company's future expected cash flow. Means in future you are expecting 10,000 rupees. What is the actual value of this 10,000 rupees now? You will going to earn 10,000 rupees in the let's say after 10 years, after 15 years. What is the actual value now? That is the DCF method. So in this DCF method, we use which kind of income approach? That is net operating income approach. Clear? So we have different income approaches: net operating income approach, net income approach, Modi Gilani Miller approach, traditional approach. But we don't have to study the all the methods, the structure of our company. We only have to know that income approach, it includes the net operating income, determination of the value of a company. Done. Any doubt to anyone? Again, market based approach, that is what is your market value. That tells the market value, means market price into number of shares. Again, the same thing. The market based approach determines a company's value by comparing it to the similar companies or transactions in the market. This approach is often used when there's an abundance of publicity available data on comparable companies. See, market based approach, it also tells that if you have if you have a similar type of business, so if you are unable to calculate your own value and you have a similar type of business, so you can know their value, and accordingly that you can set your company's value. That is market based approach. Now, cost based approach is what? That is also known as asset based approach, the book value. Then book value amount mentioned, the amount which is mentioned in the books of account, that is cost approach. At which cost you have bought the company, at which cost you have acquired all the assets, at which cost you have done the investment. The asset based approach or cost approach is a way of determining a company's value based on the value of assets. Am I clear till over here? Tell me, is everything fine? Okay. On the value of assets, things the company owns and subtracting its liabilities, means the same which we have done over here. Assets minus outsiders liabilities, that is the assets minus outsiders liability. This method is most commonly used for companies that have a lot of physical assets. If they have a lot of assets, they have a lot of property, equipments, and when a company is in financial trouble or being liquidated, we know that we have a lot of debt on our head and we also have a lot of assets. So in such case, the asset based approach is good for analyzing, for making, for finding the actual valuation of a company. Now, for example, assets are of this value: equipment, inventory, cash, total assets. So, total assets is how much? That is 14 lakhs. Okay. If you will see in terms of rupees, then that is what? 14 lakhs. Now, liabilities are how much? That is 5 lakh. Accounts payable is how much? 1 lakh. Total liabilities are how much? That is 6 lakh. Clear? So equipment is 2 lakhs, inventory is 2 lakh plus 150. We don't have to calculate what cash. We will not going to calculate now. Cash is approx. If you will tell, if we have to ask the whole total assets, that is 50,000. Now, so total assets, the valuation is what? The 14 lakhs. If you have to find NAV, that is net asset value. So what you have to do? You will minus, so from total assets, you will deduct all of your total liabilities, then it is net asset value. So company's worth is how much? The company's worth is 8 lakh rupees. Am I clear? Tell me. Clear? So all this total is what? The 14 lakhs. And the liabilities are how much? 6 lakh. Simply deduct 14 minus 6, that is 8 lakh. So this is the net asset value, or you can say the cost approach. Now, adjusted book value approach. Tell me any doubt to anyone? If you have any doubt, then ask me. Here now. Adjusted book value approach, another method of for what corporate valuation. Means in this case, the book value is being adjusted. Okay, book value is being adjusted. It means what? You have to less the depreciation over here. Less depreciation. In adjusted book value approach, what we do, we deduct the depreciation. Adjusted book value approach is a refined version of the basic asset based approach for valuing a company. So what was asset based approach? Asset based approach was what? Just now we have done. That is the book value. In this book value, we will deduct what? We will not going to consider what? Depreciation. Why? Because depreciation is it is a non-cash item. Depreciation is a non-cash item. From machines, the value of machines is being deducted. That is in terms of depreciation. So it is not a cash item, it is a non-cash item. While the basic asset-based method uses what? The book value method. The adjusted book value approach makes adjustment to ensure that, see, in simple book value approach is what? Everything which is mentioned in the books of account, we follow that. But adjusted book account value approach is that we have to do some modifications in that so that the accurate value we can get, we can find the accurate value of the company if we want to do the valuation of the company. So what we can do in this case, we cannot consider depreciation. We will only consider all the important assets. Okay, and from those assets we will deduct the all the liabilities. So adjusted book value means in the adjusted book value approach, the value of the company's assets and liabilities is adjusted to reflect their current or market value. So we do some kind of modification. We adjust in such a way that it may reflect the true and fair value of the business, that it is related to all the current and market value rather than just relying on the historical or accounting values. So whatever in historical we have recorded that value, so we need to change. If the market value of all your assets is like you have recorded your assets in the cost value, like the cost value was 10 lakh rupees, but now this particular machine, the value of this particular machine or this value of this particular land and building has increased to 1 crore. Okay, so we will modify accordingly, that if we are using what? Adjusted book value approach. Why this is important? Because the values listed on a company's balance sheet may be outdated, and it may not reflect the true and fair view related to the market conditions. So we need to adjust that according to this approach. If we are opting for this approach, we have to make the further adjustments while making valuation. Stock and debt approach. Again, this is a next type of method, the approaches, or you can say methods. The stock and debt approach. So stock and debt approach, it is a financial management concept that it typically tells that how much operations the company is making, how much growth the company has made, what is the company capital structure, how much debt the company has taken, how much debenture holders the company is carrying, the burden of interest the company has. It will analyze all the stock and debt approach. Debt means what? The borrowed money. If a company is over levered, over levered. Can anybody tell me what is over levered or over leveraged? Over leveraged or over levered means what? Tell me. Over leveraged means what? When a company has borrowed a huge amount of money for its business, for its day-to-day operation, then that is known as over leveraged. Okay. So in this case, what happens when a company's securities are traded on any public exchange, the worth of the company can be determined by simply adding the current value of the outstanding securities. That is what we do in stock and debt approach. We have to see that how much the company is being leveraged, how much the company has borrowed the money, and after that, we will see that its securities are being traded in the stock exchange or not. So this involves what? Raising capital through the sale of shares. So if your company has a lot of debt, so what you will do ultimately, you will sell all the shares of your company so that in return you get the money. Shareholders in return, they get ownership rights in the business. And when a company securities are traded on public exchange, the worth of the company can be determined by simply adding the current market value of all the outstanding securities. So if your securities are traded on the public exchange, that is, if your securities are traded on the stock market, so value of your company that will be determined by adding all the current market value prices in your company of all your outstanding securities. Clear? Now, next is direct comparison. See, from the name itself, it is clear that you are comparing with another business. Suppose this is your business. The name of your business is ABC Limited. Okay, you are unable to find the value of this company. Okay, neither you are using the cost method, neither you are using the market value, neither you are using the book value. You are unable to calculate the actual value of this company. But you know that you have a similar type of company in the market. Let's see that say that PQR Limited. All the operations, all the people, all the transactions, all the working criteria, okay, working environment, everything is same. Your company is related to this particular company. Everything is same. 95% of the things are same in this company also and in your company. So what do you do in this case? That you know that you don't have to, if a investor will come, investor will say that I want to purchase your company. Okay, you will say, okay, I will sell my company worth rupees 120 crore. Now investor will see that this is also the same company. 95% of the operations are same similar. Now the investor will go and ask, okay, the acquirer will go and ask that I want to purchase your company. This company will say that, okay, I'm giving you at 80 crore. So what this person will say? This person will say that I'm acquiring the I'm also getting the same company as yours. All the working phenomena, all the transaction operations, everything is same. So that company is asking 80 crore and you are asking 120 crore. So why would I be giving more money to your company if I'm finding the same company as yours in 80 crore? So this is what the direct comparison approach, where all the value of the assets is determined by comparing to a similar company, and on the basis of that company, the valuation of the company is being given. The direct comparison approach is founded on the principle of substitution. What is principle of substitution? See, principle of substitution is same like I want to purchase a land, okay, 1 acre land. See, a buyer will generally choose a cheaper alternative. If buyer is getting a home for a similar type of house in the same area for 7,50,000, so why would a buyer will pay 1 crore for the similar type of house in the same area? No, definitely the buyer will going to purchase this house. So it generally choose what a cheaper alternative that meets their needs if it is available. For example, buyer might not pay rupee 1 crore for a house if they can buy a similar house in the same area. That is what this particular method is dependent upon direct comparison approach, which states that buyer will not pay more for a given property than the cost of the comparable. Why would I will give more? Why would I give 120 crore if I'm getting the same company in 80 crore? This is what direct comparison method. If you cannot find the value of your company, if this investor cannot find the value of this particular company ABC Limited, so he will find another company who is working in the same manner. And then they will compare the company. So worth of this company is 80 crore and this the owner is asking 120 crore. So definitely this person will going to purchase this company. That so we have done few approaches to corporate valuation. And more in this video, you will be finding some numericals problem as well. So we don't have that much time. We can complete all the numericals part. Okay. I hope everything is fine. Everything is clear. So let's meet tomorrow with a very new topic. The new unit of module C. So till then, take care, everyone. Goodbye. Keep studying. Keep watching. And if you have not subscribed to the channel yet, kindly subscribe the channel, like the video, and share it with others as well.